recipes for technical trading success in Cook's Kitchen.
Hey everybody, Cooker here. Welcome back to Cook's Kitchen. Great topic this week, why the national debt is irrelevant. And I've got a set of logic that I'm going to put together and hopefully persuade you to think in this direction, if not completely, at least partially, maybe some things you haven't considered. And this was a topic I actually did for Zacks Ultimate subscribers on Monday, April 5th. And a couple weeks prior, I had sort of framed it this way for our viewers. In late March, I said, okay, this is going to be the agree to disagree topic for ZUS. It's something we do every month where two of our strategists will debate a topic, and not really a formal debate, but each present their side, and we agree to disagree. And so I framed America's national debt. Are we headed for a government-led financial crisis? There in yellow, you can see in early March, the Congressional Budget Office came out with new projections, projecting a nearly 60% increase in the national debt to $44 trillion just over the next 6 to 7 years. Sounds like a disaster, right? And by the way, we just crossed $28 trillion in the national debt. So, what happens if interest rates start to rise? The debt clock disaster is looming. Little did I know, so I picked this topic in late March, and then I filmed my piece on Monday morning. Little did I know that on Sunday evening, that this was also John Oliver's topic on Last Week Tonight. I think that's a Sunday night show on HBO, and then they posted to YouTube. Well, somebody just sent me the link after watching my ZUS presentation that we just gave to subscribers yesterday. They said, "Hey, do you know that? Did you base this off of John Oliver?" And I flatly did not. I did not. I don't watch him regularly. Once in a while, I'll catch it on YouTube or something. The reason that the customer asked was because we came to a similar conclusion about the concept of, the national debt is selling our grandchildren's future. Is that true? Well, people were panicking when the debt first crossed 10 trillion and we had to add an extra digit to the debt clock. I think that was back in the early 90s. So anyway, John Oliver, whether or not you agree with his politics, he did his 22-minute show on this topic, and always funny, but still worth a watch because he does some educational stuff as he always does and makes it funny, regardless of his politics. So, but I'm going to try and do this in less than 22 minutes. So let's get going. And this is I'm basically giving you the presentation, but I do have some new insight from another conversation that happened this week between Cathie Wood and Elon Musk. We'll get to that. Okay. So U.S. debt is going to double GDP. How soon, and does it matter? Here was CRFB. That's the Committee of Responsible Fiscal Government or something like that. Basically a budget watchdog in Washington. But you can just look them up there, crfb.org. Anyway, this chart, debt will nearly double in 30 years. Boy, oh boy, this is scary, right? Well, guess what? We're already there. This data that they based on CBO, Congressional Budget Office projections, is from January 2019. So the reason I'm showing it is because 2 years ago, we were already aware of this looming scenario that debt will not only exceed GDP, but that it will probably double it in 30 years. And that's what they were saying right there. Well, we're well on the way to that because at 28 trillion, depending on what this year's GDP is, you're talking 130 to 140% of GDP. Okay, so does that matter? Well, let's look at how it grows. Obviously, it's the deficits, year in, year out, spending more than we take in tax receipts. And we're going to do another 3 trillion this year after 3.1 last year with the America Rescue Plan Act. Then it mellows out a little bit, but they're expecting, at least 2 trillion, probably a running average of 2 trillion a year in deficits. Sounds scary, right? All right, let's keep going here. So, and don't even look at the interest service, right? Here's a CBO projection. This is also from their early March report. And look how the net interest spending grows. There's the primary deficit year in, year out, and there's the interest growing. So obviously very scary stuff, right? Now, and what we're going to do here is we're going to look at why it's not so scary, because the old ideas that debt should be low in relation to GDP are very outdated, and I'm going to explain why. Now, let's look at the largest source of tax revenues. This is also from the CBOE or CBO. I always want to say CBOE because I'm an old options guy from Chicago, so Chicago Board Options Exchange, but just CBO, Congressional Budget Office. All right, what's the biggest component of tax revenues? It's growth in incomes. They call it real bracket creep. The process in which, as incomes rise faster than inflation, a larger proportion of income becomes subject to higher tax rates. All right, keep moving here. Hey, corporate profits, how big are they? I actually thought they were bigger, that in 2018 and 2019, we had, gotten closer to 2.5 trillion. But this is showing that 2018 and 2019 were pretty evenly matched, around 2.25 trillion in corporate profits. And obviously 2020 had a drop off for reasons we know. But I say, and hopefully taxes, because, you may have just seen the story recently that 55 corporations in the Fortune 500 somehow avoided or were able to pay zero taxes for various reasons. Maybe Amazon was one of them. So that, we want our corporations to pay their taxes. I don't want higher taxes for myself or for you, but it doesn't hurt corporations that much. It doesn't really stop them from investing in their business in a healthy economy. Okay. So now, what could be one of the biggest areas that we could work on to get some control of deficit spending? Hey, maybe there's an answer in Congress somewhere, because you see that this gets used as a political weapon. One side says, "Oh, we're deficit hawks, and we're selling their grandchildren's future," and it's basically virtue signaling on the debt. But it seems like every time somebody gets elected on that platform, they turn around and spend more anyway. They're a major contributor. So one way to look at this, this is a really good essay on Mercatus. Are fiscal rules an effective restraint on government debt? And it's worth looking at, because the problem is that the budget process is so full of partisanship and political scheming. And I just want to go to that Mercatus page real quick. Much of the debate surrounding budget process reform involves corporate welfare and earmarked spending, or items slipped into legislation by lawmakers to benefit particular special interests. There it is, SI, special interests. As Chris Edwards at the Cato Institute notes, with more than 1,800 different subsidy programs, the federal budget has become a giant favor factory for organized pressure groups at the expense of average citizens. And so it's no doubt that the budget always contains more spending than the last one. Again, this is from the same article, Are Fiscal Rules an Effective Restraint on Government Debt, from July of 2019. All right, back to my deck here. I think this has got about a dozen slides or so, so hopefully I can do this quicker than John Oliver. All right, moving along. Let's talk about the wealth of a nation. John Rutledge, he was an economic advisor to Reagan, and something I learned from him about 13 years ago, 2009 actually, was looking at the total assets of the U.S. economy. Everybody's focused on GDP, but he was focused on what is the true wealth of a nation. and he came up with a calculation that gave him 188 trillion. But he thought the actual number was closer to 200 trillion in wealth. No, I'm sorry, in assets, not net worth, but in assets. An order of magnitude bigger than GDP. And I thought this was an important idea that most people got wrong. So when they were concerned about the Fed increasing its balance sheet, oh my gosh, the Fed's balance sheet is up to 2 trillion or whatever, 4 trillion, and now it's 8 trillion. That was a big deal in spur for the price of spurring growth. All right, let's keep moving along here. So I wanted an update. Well, so where are we now, John? I couldn't find, I Googled John Rutledge, total assets of the nation. Couldn't really find anything, but my top result was this Google page or this Wikipedia page. This is a Google search result. And this is from Q1 of 2014. So, basically 5 years after John was talking about 200 trillion, the financial position of the U.S. includes assets of at least 270 trillion, which is over 15 times GDP, and debts of 145 trillion for a net worth of about 124 trillion. Net worth, pretty awesome number there, right? And that was 7 years ago now. So something to pay attention to. And this is the theme I'm building here about putting the debt in perspective. And there's another major force at play here. Oh, so we could also look at how big is the stock market relative to GDP. Remember this is like Warren Buffett's indicator when the stock market became greater than 100% of GDP. Maybe that's a warning sign. I don't think it is anymore. And if you want to track it, you can track it every day if you want, just by looking at the Wilshire 5000 Composite Index. Symbol is WLSH. I'm using stock charts right here. This is expressed in billions. So this number you're looking at here, 42,615, that's in billions. So that's 42 trillion. So the stock market is definitely double GDP right now. Is it a big deal? I don't think so. And we're going to keep going, and I'll tell you why. All right. Oh, so I mentioned we're going to bring in Elon and Kathy into this discussion because the night, so I filmed my thing on Monday morning, April 5th, and then that night, Elon Musk turns around and ats Kathy Wood on Twitter. What do you think of the unusually high ratio of S&P market cap to GDP, which was the chart we just looked at? Again, well, I don't have GDP on here, but clearly if you think of GDP as being, say, 21 trillion, the stock market at 42 trillion, is double GDP. Okay. So we're going to come back to Elon and Kathy and see her response. Let's keep talking about wealth, though. I want to drill down farther because this is fresh data that I can confirm. Before I told you that in 2014, we were looking at a net worth of the United States of 124 trillion. We're definitely blowing that away now because here's private household wealth. This is as of Q4 of 2020. And this chart was put together by Scott Granis of the Calafia Beach Pundit blog, an economist. And look at the net worth there. So that's, he's taken out the debt. So net worth is 130 trillion. And I'll show you where he got the data from, because this is from the Fed. On March 12th, the Fed released its estimates of household net worth, and the private sector of the U.S. economy, total net worth, that's assets minus liabilities, of 130 trillion. That's up 12 trillion from a year ago. And Scott says, recent experience is not at all out of line with what we've seen in the past. That seems like a subtle nuance, but it's important. What he's saying is that this big swing in wealth it happens occasionally, and it can come out of nowhere, and it can be unpredictable. So it has happened before. It will happen again. All right, keep moving here. What do we call economics? It's the dismal science, right? It's a prediction machine that has very little prediction power. So all these old rules about, ratios. Hey, it's great for your bank to have, they want your income to debt ratios to be in a certain line, so they know you can afford the mortgage you're taking on, and against your other credit cards and stuff like that too. But we don't know how that applies to an economy as dynamic as ours, and one as resilient to shocks as ours. If we can have some monetary and fiscal support. So nobody knew what to do after the great financial crisis. And when interest rates started to rise in 2018, that seemed out of line because inflation expectations were not really there. There's just still no inflation. So we're going to come back to that inflation idea. And who knew that we'd still be having zero interest rates here? I mentioned Mandelbrot and Taleb because this is what, the dismal science does not understand the complexity of multidimensional systems, that are operating basically off of human behavior. These are not, you can't just plug these in to a spreadsheet or historical volatility or standard deviation of any kind. So that's why I mentioned them. If you haven't read The Black Swan, read The Black Swan or look up a book by Mandelbrot. His book is The Misbehavior of Markets. Okay. So we're going to talk about exponential wealth creation. This is what I'm getting at is here is where wealth is coming from. It's coming from technology innovation. So I talk about exponential wealth creation, and I talk about exponential technology innovation. So EWC, exponential wealth creation, ETI, exponential technology innovation. These two drive each other. So who predicted any of this? Google and Amazon, Apple, smartphones, social media, SaaS, the cloud, apps, genomics, industrial automation, 3D printing, robotics, Tesla, NVIDIA, artificial intelligence, Square, and fintech, Bitcoin and blockchain. None of this, nobody was predicting the wealth creation and technology innovation from these things 10 years ago. So why would we listen to them about the national debt mattering when here is where wealth creation is coming from that can definitely take care of the debt once we get through this crisis? All right, keep moving here. So in 2017, I wrote one of my most important pieces called the Technology Supercycle. And this is you can find this video. If you just search Technology Supercycle on Google, you should find this video I did with an article version of the piece that I actually wrote in December of 2017. So here it is, 12/11/17. Innovation is driving earnings growth in unseen productivity and efficiency that keeps inflation low and investment high. And I relied on two economists to help me put my ideas together because I wanted to know, because I had the questions. Why is inflation still so low and thus low interest rates? And why does productivity, like the government publishes a productivity number and it's like 1% productivity or even less than that? It didn't make sense because it seemed like every piece of technology was making individuals and corporations more efficient. And look how corporations were growing their sales. Any high technology industry was growing their sales at 30%. How could you grow your sales at 30% and maybe even your profits at 20% if you weren't having massive productivity? So I wanted those questions answered. And so the two economists I found to help were Brian Westbury of First Trust, number one, because the missing link. Why are the government's productivity numbers so low? And he explained it just basically because the government is such a big part of the denominator of any productivity calculation, and the government is not productive. So it's corporations. You can measure productivity in an industry. So you can have the cloud or mobile growing at or having productivity growth of 5-10% that you don't see unless you break it out. And the missing link number 2 is inflation. And I found a great piece by Joe Davis of Vanguard. Also, very recently in 2017, he talked about the Federal Reserve versus Moore's Law. Moore's Law, as you know, is just chips getting, doubling in power and halving in size every 18 months to 2 years, and that is still going. In fact, it leveled off for a little bit, but now Nvidia has sort of reinvented that. So those were that was part of my technology super cycle thesis in 2017. And this is important because it explains why inflation is still low and why the debt doesn't matter when all this wealth is being created. So let me show you. Along the idea of, should fiscal policy be used differently at different times? Anybody crying about the debt? Well, here's the discussion I got into with Joe Weisenthal and Ari Paul and an economist named Rohan Gray about the government should have always been doing more with some kind of fiscal stimulus to get more people back to work quicker. And now we're sort of learning that, and again, the other part of the biggest part of the debt is sometimes the unfunded liabilities like Medicare and Social Security. Okay, now to the Cathie Wood discussion with Elon Musk here. So Elon asks, here's Elon's question: what do you think of the unusually high ratio of S&P market cap to GDP? Again, this is a conversation they had Monday night. Cathie Wood says GDP statistics evolved during the industrial age and do not seem to be keeping up with the digital age. Thanks to productivity, there it is, real GDP growth probably is higher and inflation lower than reported. That's, this is what I've been saying. This goes back to my technology supercycle thesis of 2017, suggesting the quality of earnings has increased significantly. And then she spends about 4 or 5 more tweets, really fleshing it out, talking about technologically enabled innovation evolving today is dwarfing that during any other period. And that's also people. One of the great things about the John Oliver piece is he goes. He says, I'm not an economist, but so he talked to a few, and he says, I'm trying to find out why are interest rates so low, and how, so how can we can sustain this debt load because interest rates are so low, but why are interest rates so low? And he shows a clip of an IMF economist who says, we have no idea, and and that's, to me, it's just absurd, because if you had asked me or Cathie Wood or Brian Westbury of First Trust, you would know why inflation was so low. It's because of technology innovation. It just like Moore's Law. Everything gets better, cheaper, and faster, and reduces costs, and yet companies can still grow profits within that, especially software, or something like genomics. So Cathie goes on here talking about deflation, and how persistent it is during this, an explosion of technology innovation. That's what you should expect. So she says, after gestating for 20 to 30 years, the dream has finally turned into reality. She's talking about how the dot-com bust, we were sort of ahead of our skis, right? We had all these dreams, but everything was too costly then. And we didn't have the innovation to make it real. So she says, there's a lot of skepticism now, but I would prefer to invest in the face of fear rather than exuberance. Well said. All right, so you can check out that thread where Cathie answers Elon on Monday evening, April 5th. Back to my conclusion, if I can find it here in my wonderful slide deck. All right. So my conclusion is that we have bigger fish to fry than worrying about some arbitrary debt to GDP ratio. which is going to go to 200%. Everybody knows it. And it's not scaring the bond market. Do you see the bond market heading for the hills? Do you see the 10-year yield at 3%? No. There's no inflation, and it's because of exponential technology innovation. But that's also going to create technological unemployment. Okay, and we just got our first fire drill with that. I say the pandemic just gave us our first experiment in UBI, universal basic income, because we're sort of, I think it was a good fire drill because there will be technological unemployment. It's the nature of disruptive innovation. So maybe our wake-up call is not to start making plans for UBI, but to make plans to put people to work. So maybe we'll learn something from the new infrastructure bill about, having more public works programs, putting people to work who want to work. And so finally, is the national debt really a burden to our grandkids? Well, here's what I think. Kids 20, 30, 50 years from now, I think they'll look back and say that other things were more important to them. I think they'll wish that we had gotten other things right and focused on them, like getting education right, both at the, K-12 level and college, making college affordable and then useful, getting healthcare right, dealing with poverty. In the wealthiest nation in the world, we still have children who grow up in poverty and they have no choice. We may not be able to influence or change their parents, but we can do something for kids who are growing up in poverty. So I think these are the things that our grandkids will wish that we had gotten right and solved these problems. All right. Thanks for joining me in the kitchen. Think about the debt. Email me, leave a comment on YouTube, and we'll talk to you next week.